Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
ConocoPhillips agreeing to acquire Marathon Oil in an all-stock deal valuing the company at about $17 billion. It extends a major buying spree among the largest players in the U.S. oil and gas industry. Back with us is Bloomberg radio and television anchor Alex Steele. She's a go-to for us when it comes to the energy world.
And she's wearing beige, like you knew something.
This is cream, girl.
Okay.
Come on now. It's cream.
She also co-hosts Bloomberg Intelligence weekday mornings on Bloomberg Radio and The Close weekday afternoons on Bloomberg Television. So this deal, a surprise?
Yes and no.
Okay.
So
explain, please.
Devon was also rumored to be interested in Marathon Oil. We reported that maybe Conoco would also be interested in it. It's not a surprise in that there's been a ton of M&A in the space, and it was just a matter of who was going to be buying up and what was left to actually buy. I say yes in that Conoco has been very restrained, and Conoco usually moves ahead of the pack, and they bought Contra Resources back in the pandemic, and they haven't bought anything since, and they were really ahead of everything else, and they usually are the ones that kind of set the tone for the oil producers.
Yeah.
So going to buy, so then that was to me kind of interesting that they're going to go back and buy. They've been putting a lot of time and energy into LNG, so from that perspective, it was a little bit of a head scratcher.
What the heck is going on? Is it just, everybody kind of like, consolidation, like, why is it? Is it just bigger, better in this industry at this point?
Such a good question. Okay, so at the heart of this is the fact that if you're a portfolio manager or an investor, you can't own a bunch of oil stocks. You can own one, maybe two. So if you're an oil company, you cannot afford to be one of many. You have to be one of few because you're all competing for the same kind of capital from investors. And at the heart of it, that is what's happening in the M&A space. In addition to that, on a geographical level, there's only so much rock in the Permian, and there's only so much rock in the Eagle Ford and the Bakken, and Conoco has something a bit different with this one. And scale is master, and scale is master because when you're using shale, you drilled down and then you drilled sideways, and that's called contiguous. And the more acreage you have sideways, the longer you can go and the more you can drill, and you have to go buy up all those areas. So that, in essence, is one part of it. For Conoco, this gives them more inventory in the Bakken and the Eagle Ford. Both of those have already been drilled, and they talked a lot on the call about refracs. So that's like, here's my well, I fracked it, I'm going to go back and refrac it and get more oil out. It's cheaper, but it's not going to be as good as the well that you first did.
Not as productive.
Right, but the production in the Bakken and the Eagle Ford has really leveled off. It hasn't had the same kind of explosive growth anymore as it once did. And so you can make an argument they're just literally building up inventory. Just straight up, here it is, stick it in the ground, get the oil out, get the money, bye-bye.
Regulators are going to say this is totally fine and we approve this 100%.
No,
issues?
I think there's going to be problems.
Okay.
I'm not just me personally. I'm not a lawyer, thank God. But Vince Piazza, Bloomberg Intelligence.
We love lawyers here at Business
David
Week,
Weston, we love you. But
yes.
he thinks there are going to be issues because of the overlap in the Permian, the Bakken, and the Eagle Ford.
Meaning
sure.
a geographic impact.
Yes. But also on the flip side, there's still like 400 private players, small guys in the Permian. So you can't make an argument that there's only like 3 players and we need to keep it that way, right?
So what do they do? Sell off some stuff to get this deal through? Or
so they could do that. They did say that they will have to do some rationalization eventually. I'm assuming that that's what that meant. That was on the call. That would probably help. But they said they think it's, quote, pretty clean. I don't really know what that means. I don't know how you get pretty clean for the FTC.
You mentioned hundreds of other players.
400 private players.
What are we talking about here? I mean, who
mom
are
and
these?
pops.
Okay.
I mean, some of them are obviously bigger than mom and pops. There's some private companies that have had like very big deals that have come out in the last few months. But a lot of them are just like small mom and pops that have just kind of gone with the flow over the last couple decades.
The reason I'm asking is because Carol and I were like, okay, who's left at this point when it comes to potential targets for acquisition?
So of the 3 big players that were talked about when Exxon first bought Pioneer, it was Endeavor. It's a legacy Midland play, and that was bought by Diamondback for about $26 billion. Crown Rock, also private, and that was bought by Oxy for a little over $10. The other one that's out there is Mewbourne. I don't know anything about this company, but it is a Delaware basin play, sub-basin play. That hasn't had any M&A, but that's one out there, and that's one of the largest private players still left. And then there's a lot of small guys. And there's been some mid-tier acquisitions. Silverbow got an acquisition offer. So there are sort of the smaller ones teaming up. There's also Matador Resources have been floated by some analysts, Permian Resources, SM Energy, pretty much throw a dart and you'll find a company that's there.
So when you look more broadly at the space, I know we talked about this yesterday, and I just think about like what's going on in the exploration E&P space. I mean, are people still? I find it. I'm trying to get my head around. Okay, we're supposed to be moving towards more renewables and a cleaner, greener space, and yet I'm just curious, like how much is still going on in terms of exploration and looking for new sites and so on and so forth? Because we're going to be living with fossil fuels
for sure
for years, decades still?
Oh, yeah. I mean, demand growth may slow, but that doesn't mean demand goes to zero. And therein sort of lies the rub, right? You can look no further than what happened with Anglo American and BHP when you talk about the search for resources and the idea that it's going to be cheaper to buy than build. Now, many in the industry are going to debate that, and they're going to say, that's not true. That's not what this acquisition is about. This is about just really beefing up our portfolio. It just makes really good sense, yada, yada. But at the end of the day, if you're a producer, would you want to spend $1 bazillion going and searching for oil or copper or somewhere, and then dealing with all the regulatory issues, the geopolitical issues, the higher input cost issues, all the stuff?
No.
When you don't know what the profile is going to be like in 50 years, or do you want to buy something now that you think with your technology and your expertise that you can lower the cash cost by a couple bucks, and that makes you even more money?
So who's doing the exploration right now when it comes to oil?
Middle East. The Middle East is still definitely exploring because they have nice checks that they can cash. They just mint money from oil, and they can do that, and they are doing that. Yeah. And some of it's going to be gas, and some of it's going to be oil, and the other one is Guyana, off the coast of South America. That's really the big one.
But here in the U.S., not much exploration happening.
No. It's just Permian and other shale areas. I mean, there's Appalachia, and that's gas, and it's about using different technology to get better and getting more out when you are doing something than straight up sticking something in a rock and being like, let me see if I strike oil.
Before you go, because we had a great conversation about the energy space yesterday, and then the headline comes that the Hess investors voted in favor of the $53 billion deal offer from Chevron. What's next, though? It's not, is it done?
God, no.
I know.
No, they're still in arbitration.
Okay.
And I don't think anyone has any idea how long that's going to take. I know that Chevron's like, hey, end of year. I don't think anyone knows how long that arbitration is going to go. Maybe Hess and Chevron will go back to Exxon and be like, here, we're going to sweeten some stuff. We're going to give you something to just let this deal go through. But I don't know what the timeline of that really looks like.
Okay, so stay tuned again for that.
I'll be back.
Thank you. Always welcome. Anytime. Open door. Beige or no beige. Cream or no cream. Jinx. All right, Bloomberg Radio and television anchor Alix Steele, go-to for us always on everything in the energy world.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We've also reported on the stressed out supply chain that is the new class of weight loss drugs. You know, Wegovy and Ozempic and others. So we've talked about that a lot, too.
Yeah, well, there's actually a free tool that can help with that stress. As reported today by Bloomberg's Madison Muller, the startup Row has created an online tracker, Carol, that helps patients and doctors find supply of these hard-to-get drugs.
All right, here to talk about it is Madison. She's Bloomberg News health reporter. She covers this space intensely here in our studio, along with Zach Reitano. He's co-founder and CEO at the health tech platform Row, which handles everything from online diagnosis to the delivery of medication. Z joining us from Sarasota, Florida. Z, great to have you here. Madison's here in studio with Tim and myself. Z, let's start with the reaction.
Thanks for having me.
Yeah, great to have you here. Talk to us about reaction to the news launching the tracker today. Tell us what you've heard so far.
Yeah, thanks again for having me. Just zooming out for people to understand what the tracker does and why we built it in the first place is, as you said, we built it for patients to be able to report shortages, to give information in real time to the FDA about the real lived experience of patients on the ground, and provide the FDA with real-time information, and enable patients to crowdsource and find supply together. So a patient comes on and says, I need supply, and they'll enter in their zip code, the drug, and dose. And then if a patient comes on and says that they found supply, they'll enter in the specific pharmacy, and we will notify every patient within 100 miles of that pharmacy that is looking for that exact drug and dose match. We'll email them the pharmacy name, a link to the Google Maps and the phone number to be able to call the pharmacy and transfer their supply. So again, really trying to help patients both report shortages as well as find supply and crowdsource it together. And then we also built the tool for providers to be able to report shortages just as well as patients, but also so that they have nuanced and real-time information when creating a treatment plan for their patients. Being able to see, yes, what's in shortage and what's not in real time, but also to be able to see, even if something is listed as available, but there's a lot of shortage reports that might influence their decision.
Okay, Z, I want to bring in Madison Muller, who, as everyone who watches and listens to us knows, covers this so closely. Madison, before you get to a question... And
does it very, very well.
She does. We agree. Before we get to a question for Z, I just want you to contextualize this for us, because you've reported a lot on the shortages and what patients have had to do in order to try to find these drugs. So give us some context there.
Yeah, right. As we know, I mean, and maybe people who are listening have experienced this, in the U.S., pharmacies don't report inventory. So it's really hard to know if a pharmacy has your medication, especially when a drug is in shortage, like Adderall, these weight loss drugs. The experience of patients has been that they're having to take time out of their work days to call sometimes dozens of pharmacies in their area to find a pharmacy that has supply of their drug, and that onus falls onto patients. Some are driving hours, they're driving across state borders to find pharmacies that have these drugs. And so it's concerning for them. It causes anxiety. It also messes with the actual efficacy of their medications if they're not able to take it monthly at the same time, or weekly at the same time. And so it's a very stressful situation. The drug makers, Eli Lilly and Novo Nordisk, are investing billions to ramp up production, but it's just not happening quickly enough with how high the demand is right now.
Well, finish up, you reported on what Roe is up to. So go ahead and come on into the conversation. And
definitely. Yeah, and Z, I know that you and I have talked about this a bit, but how did what was your inspiration from what you were actually seeing from patients on social media and the crowdsourcing that was happening and sort of like the community helping each other to find these medications, and how did you take that and sort of use that as inspiration for this tracker?
Yeah, I mean, as we talked about, I think you described it really well, is we saw patients using social media, Facebook groups, Reddit subthreads, Twitter, Airtable and Excel sheets, and they were using these tools to try and accomplish the thing that this tracker does in a scaled, structured, and automated way across the country. So they were sharing with one another where they found supply, where they were calling pharmacies to try and help others, because it is. And Madison and I talked about this, is people with overweight and with obesity have been marginalized for years, if not decades. And so there's a tremendous amount of generosity and sort of shared experiences that the community has, and there's a willingness to lend a hand and help one another. Right. And as Madison said, zooming out, inventory management is a well-solved problem in other industries, right? You and I right now, we could go to Best Buy. I think you're in the studio in New York. You can go to Best Buy. And if you're looking for something, it'll tell you if it's in stock nearby, if it's available for pickup, if it's available today, how many are left in stock to give you some sense of urgency if there's one versus an infinite number. And this should exist in healthcare, right? It's a very typical, normal consumer experience. And as Madison alluded to, is that if that is disrupted, it makes it very challenging for patients to really realize the full efficacy of their treatment if there are disruptions, and every single month there's a hunt. And it's also not the best use of resources in the healthcare system for patients and providers to constantly call pharmacies and have a pharmacist always be on the phone just saying whether something's in stock or not.
And so this tool is just one of the things that you are doing to help address these shortages. And we've been talking on the show, we talked about HIMSS launching a compounded weight loss drug program, and that's something that Rose started doing earlier this year. So can you talk about the different ways and the different options that you are giving patients who are experiencing these shortages?
Yeah, I think you, it's no surprise you hit the nail on the head. For us, it just comes back down to options. And providing as many as possible for patients. So we do have compounded options. We also have branded options. We also allow and facilitate insurance reimbursement, and we'll handle the entire prior authorization process for patients. We offer Ozempic, Wegovy, Zepbound, Saxenda, as well as compounded options. So again, whether someone's paying cash or branded, whether they're covered by insurance or not, we want to make sure that we are fighting for patients to get the most affordable, most efficacious product, given their personal health history as well as their insurance coverage.
Hey, Z, what's the profitable part or most profitable part of your business? Is it, prescribing the Ozempics and the Wegovys? Is it the cheaper versions? Is it helping locate drugs? Help us understand your business model.
Yeah, our business model is very, very simple. We're 100% direct to patient. And we have different subscription and membership services for patients. So they'll come on and they will tell us really what we talk about, what we're building at Row is goal-oriented healthcare. So a patient will come on and tell us what they want to achieve. So they'll come on and say, I want to have a child, and we have fertility products and services. I want to have better sex, and we have products for sexual health. Or I want to lose weight, and we have obesity care centered around GLP-1s. And all of those are a simple subscription service, very similar to other subscription services that people have in their life. And what that does is it fully aligns us with the patient. Every single day we wake up and we have to earn. People don't part, as you all know, people don't part with their hard-earned money very easily. And so that is something that we've always prided ourselves on, which is we align ourselves with the patient. And if we deliver a really effective service and membership and help them achieve their health and life outcomes, then they stay with us.
Hey, yes or no, are people already using the tracker real quickly? Are you seeing an uptick?
They are. We've already seen well over 1,000 submissions of shortages in supplies. So we're encouraged by the reaction only in a short 5 or 6 hours since it launched this morning. And
so appreciate it. Hey Z, thank you so much. Z Reitano, the CEO at Row, and of course our own Madison Muller joining us in studio. Folks, you are listening and watching Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Okay, if you're not flying somewhere exciting this summer, maybe you can find some of that excitement at Dave & Buster's?
What?
Yeah, well, you probably know Dave & Buster's. It's like the Chuck E. Cheese-like entertainment chain where kids have birthday parties, or you can play some skee ball while you munch on your all-you-can-eat wings or half-price Maz sticks. Dave & Buster's actually wants to add a bit more excitement, though, to your typical game of skee ball by allowing you to bet on the outcome of arcade games with a friend or a random stranger. It's something that Bloomberg Businessweek senior reporter Amanda Mull writes about in the forthcoming issue of Businessweek magazine. It's about the casino-fying of Dave & Buster's, as well as, well, pretty much everything here in the U.S. now. She's here in the Bloomberg Interactive Brokers studio. Amanda, welcome. Good to meet you.
Thank you so much for having me. I'm excited to be here.
So we know the news about going to Dave & Buster's and betting on arcade games, but the bigger story that you write about in Businessweek is this idea that everything is becoming a casino and we can gamble on pretty much everything these days. Why does that concern you?
Well, I think that as we see opportunities for betting leaking into more and more parts of society, and this is the stated goal with the Dave & Buster's initiative too, this idea of just betting on everything, betting on any sort of like chance that's in front of you, it gets more and more normalized. And especially when you're in a situation like at a Dave & Buster's where a lot of kids are going to be present, you establish and normalize a set of behaviors for children that are then going to follow them in their entire lives. We know that betting can be extremely habit forming, and for some people addictive and really hard to undo once they get in the habit. So moving this into more and more parts of daily life and entertainment just seems like a risk that we have not fully appreciated.
I have to say, Amanda, one of the most terrifying stories that I did, I don't know if it was the most terrifying, but it was worrisome, years ago, being at actually like a lottery ticket place outside of Washington, D.C., and people would just go and they'd drop $20 and then scratch off other tickets and then, come back and buy another $20. And you just realize like just how addictive this was. And
this is lottery. This is like a state-sanctioned.
Yeah, exactly.
Yeah.
Okay. And I do wonder, how they are able to do this, first of all, at Dave & Buster's, where kids are. How is that even possible?
Well, Dave & Buster's has been really careful so far to keep its betting initiatives on the side of what's legally referred to as a game of skill, which means that you have to, the outcome has to substantially rely on your own participation in some way. Like daily fantasy sports are a game of skill. That's why you could play them on DraftKings and FanDuel before there was like widespread legalized sports gambling in the U.S. at Dave & Buster's, what we believe to be happening, they haven't released a lot of details on this yet, and it hasn't launched yet, is that you will be able to place wagers on games that you're participating in. You have to like sidle up to the skee ball lanes and bet on your own success or failure versus an adversary.
You come up and like somebody else is playing and you're like, hey, I'm going to bet you that I can do this, and that's okay.
Right. Yes. So that makes it a game of skill. You're relying on your own abilities instead of your own guess about what will happen in a particular outcome. So that makes it legal.
Can little Johnny, who's 10 years old, do this?
It is cut off at 18 years old.
Okay.
We know that it will be adults only.
Or Jane. Jane and Johnny both play.
Yes. It's cut off at 18 years old. We know that. There will be some sort of ceiling on the amount of bets you're able to make, the value of the bets, but they haven't announced that. The details are really, really vague. What's clear is that they want a piece of the sort of like gambling culture in
Dave & Buster's.
Their restaurants. Yes.
But you know what? They want a piece of gambling culture the same way that maybe ESPN or other media companies that are looking for engagement when it comes to people watching sports and subscribing to networks want when it comes to their own businesses, which is like these companies are now seeing Vegas not being the only place that allows this stuff. And they're saying, wait a second, can we up our quote unquote engagement here?
Right, absolutely. When I was writing the article and talking to people about it, ultimately my conclusion was that Dave & Buster's is really following the lead of like the professional sports leagues in the U.S. and all kinds of media that covers sports, in seeing that this is a revenue opportunity, that this is something that they can market to their customers, that they believe that their customers might want, or at least they want to see if there's like a pickup there, and like what formats Dave & Buster's customers might be willing to pick up on. And that is just something that a lot of other businesses before them, a lot of like much larger, much more lucrative businesses, the NFL, the NBA, Major League Baseball, ESPN, have all sort of thrown in on to see like, this is, if people are willing to spend the money and if they can create habit in consumers, then they are willing to take that revenue.
Tell us about Lucra Sports, right? Because what's helping Dave & Buster's do this is this technology platform or company, right, that's involved in gamification services.
Yes. The thing that this sort of hinges on is one of a sort of cadre of companies that have come forward to figure out ways that existing corporations can incorporate these types of services into their platforms or technology. So Lucra Sports is a software company that makes quote-unquote gamification services where the company in question, Dave & Buster's in this case, will install the software services within their loyalty app that a lot of people already use, and that puts the betting within the app. And Lucra Sports does like sort of the back end. They do the compliance. They do all of this stuff that makes it sort of plug and play for companies that have no experience in this. Yes, because there's a lot of regulatory stuff state by state, municipality by municipality, when it comes to even skill gaming and chance gaming, much more so. So Lucra Sports is a company that offers these services. They're a fairly new company. They are growing. They definitely seem to have outside interest. And
some well-known folks involved. Mark Lazary, who we've talked to, is involved. Milwaukee Bucks owner, also an NFL player. Emmanuel Sanders, right? So you've got some big money, or at least people in the world of sports involved.
Right. Tennis pro John Isner. There's a bunch of people involved that have sort of seen what sports gambling has done to revenue in certain sectors of the sporting industry. I would guess is their motivation, because even though this isn't sports gambling, there's a heavy sports emphasis.
Amanda, before we let you go, it's not just this that you're writing about. We have about 45 seconds left. I want you to talk a little bit about how Ozempic and other GLP-1 drugs are affecting the food industry, but not like people think.
Right.
Because this is a Businessweek newsletter that came out recently.
Yes. Initially, there was all this sort of like fear in the packaged food industry about what Ozempic and drugs like it might do to their bottom lines.
Yeah.
Anybody who's ever been on a diet should have known that was panic for nothing, because it is very, very possible to sell packaged food to people who are on diets and trying to eat less. And that is what Nestle and other packaged food giants are figuring out right now. They're coming out with new lines, new formulations that emphasize the nutritional needs of people on these drugs. It didn't take them very long to figure it out.
They'll find a way. They always do.
And we were so worried.
And that worry was like 6 months ago.
Right.
They did this quickly.
Talk about pivots, right? Great stuff. Thank you so much. Really fun. Amanda Mull, she's senior reporter at Bloomberg Businessweek, joining us here in our studio. Check out the story on Dave & Buster's. I believe this is coming up in the new issue.
Yeah, coming up in the forthcoming issue of Bloomberg Businessweek.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Carol, I don't know if you caught this yesterday because we covered a lot of what Neil Kashkari of the Federal Reserve Bank of Minneapolis said, but not this part very closely. At an event in London, he said he sees a risk of, quote, big losses from commercial real estate. Here's what he said. We expect there to be big losses in the commercial real estate sector, and we'll be surprised where some of those losses end up. He was talking about the balance sheets and like where we'd see them, which balance sheets we'd see them on. Commercial real estate, incredibly important to the economy. It's been under pressure post-COVID as more people work from home, and interest rates hover around their highest levels in years. All
right, so we knew we wanted to check on the sector. We've got a great voice on this. Mark Gibson is with us. He's America's CEO of Capital Markets at Jones Lang LaSalle, also known as JLL. It specializes in real estate and investment management services around the globe. Think property management, think leasing, think finance, and more. Mark joining us here in our Bloomberg Interactive Broker studio. Welcome. Nice to have you here.
Thank you.
Let's start big picture because I think, we obviously watch the real estate space and all its moving parts and sectors in a big way. When you look at the group, where are the strengths, where are the weaknesses?
Well, it's hard to soundbite it.
Yeah.
Because you have a lot going on. But let's just take a step back. Real estate.
We've got time.
Okay. Well, commercial real estate houses the U.S. economy.
Yeah.
So whatever you really think about the U.S. economy in its various segmentations, you're going to find similar demand dynamics in commercial real estate. So where is it robust, and what do people think currently? So you would have to go to our living stock. So whether that's multi-housing, what most people would call apartments, and there are various degrees. You have more affordability, we call it attainable, you have market rent, you have high-rise apartments, you have garden apartments. We need more housing in the U.S., and the question is, what type do we need and where do we need it? So investors are very keen on that subject. When you think about Build Back Better and the Inflation Reduction Act and various other things that the federal government is doing to solidify, our national defense with, onshore manufacturing or nearshoring.
Or supply chains back home.
Supply chains, et cetera. So that is going to fuel demand for industrial product. So investors also see that as a major driver of future demand. Now, it will take a while for all of this to manifest itself, but you do have tremendous interest in both of those sectors in commercial real estate.
When it comes to, and I know commercial, I want to focus on, but in terms of the residential component, because it's something we talk a lot about, do you think that more supply will come in the rental side of things or the ownership side of things?
Like, how's the housing crisis going to be solved, basically?
Yeah.
Well, you have a lot of really smart people thinking about it. So think about our largest home builders in the U.S. that are meeting with government officials and saying, look, we need more housing. Let's talk about where it goes and how it goes. And the question really is it more rental or is it more ownership? And there's a big debate about that currently. And
we just did a story about the American dream maybe out of reach for a lot of Americans, especially a younger generation who just don't see how the math adds up for them.
And yet you see some of the home builders' results, which are pretty good.
Right.
So you really have to balance these, and so it's hard to answer whether it's going to be more rental or more ownership, but coming to the forefront is going to be more affordable housing, either for rent or for purchase. And we're seeing the average home price move into that, what I would call an 80% of AMI, so it's a demographic income level.
Mark, how do you know it's going to be more affordable? Is it because I feel like the affordability issue, I've been doing this a while too, it's been around we've been having this discussion for a long time.
That's a fact.
So what's the guarantee that you think that we will really build more affordable housing?
It's a great question. I don't have all the answers, but I'll tell you what we're doing in the real estate industry. One is a differentiating manufacturing business. So how do you build product cheaper and faster. So you think about modular, you think about establishing prototypes in the rental pool. So building the same project eliminates a lot of friction cost and various things in the marketplace. So you have these differentiated manufacturing processes that are in place and that are currently achieving 10 to 15% declines in construction costs. So that's one way.
Yeah.
Obviously, the biggest driver is going to be the cost of capital. So what is your mortgage rate and how do you do that? And currently, you have a bunch of owners that are buying down interest rates. So they're manufacturing a lower cost of capital in the interim. Most people believe, you were talking about the cost of capital before I came on, so if you think about the Federal Reserve and what they have control over, it's really the shorter end of the curve. And most investors are believing that will moderate over time because we have an inverted yield curve currently.
Yeah.
Most institutional investors look at the 10-year bond, and so thinking about that in the future, if we really want to incent home buying, you're going to have to see that moderation.
What's the number that you talk about internally where supply actually meets demand when it comes to new homes coming online?
You look at look at population growth across the board, and so when you look at the math, what the experts would tell you in the housing industry, Tim, is 3.5 million units we are currently undersupplied with. So when we look back in time and you can track building, we tend to go in spurts, right? Building spurts, and we just went through one actually. So we're somewhat oversupplied currently, but it takes some time for that to absorb in the marketplace, not in single-family residential, but in multi-housing in certain markets. There is no new construction, relatively speaking, compared to what it has been in past years, currently taking place. So the real question is, what are we going to do in 26 and 27?
Would you advise investors to invest in commercial real estate office properties specifically at this point?
I would, but I would also be cautious because in office it is perhaps the greatest have and have not sector in commercial real estate. So you have the haves, so those are generally newer built buildings, 2017 or newer.
Right, top tier properties.
Top tier properties that are signing the highest rents in U.S. history and are fully occupied. So that is just fact.
Right.
Then you have the next tranche of properties that are having to go through a pricing reset. And I should have started at the beginning and going, look, when you have a massive move as we have had in interest rate cost, of course you're going to have value declines in commercial real estate. That shouldn't be a surprise to anyone. So we're going through a process of resetting value based on cost of capital. We're getting very close to the end. So a lot of investors are coming into the market now because they believe we're at or near a bottom, one. And two, they're seeing office as completely oversold. And so we're seeing institutional capital for the first time in about 3 years jump into the office sector.
Pricing. Go ahead.
Yeah, just Mark,
Please.
we only have 45 seconds left, but I want to touch on data centers because it's a really hot play right now for a lot of people thinking about exposure to AI and the boom that we've seen there. Give us 45 seconds on your thoughts around data centers.
It's an interesting place to be, obviously. So all you have to do is read the press and see what we need in terms of processing capability. It is constrained by power, and that is a fact. So we don't really have the power necessary to fuel what they're telling us we need. Having said that, the price to play in that field is significant. So we're not really looking at anything less than $1 billion. So think about who can do that. So there are some barriers to entry there, but there's no doubt there is demand. Tim.
Generally, just 20 seconds, the environment good, okay?
I think it is. I think it is finding its footing.
Yeah.
I think you are seeing large-scale investors on a risk-on perspective for commercial real estate. And again, I'll just make a statement. If you buy really good quality real estate, you don't over-leverage, it does very well over time. And it's a long-term store of value. Institutional investors are making that play today.
Thank you so much. Really appreciate it.
You bet.
Mark Gibson, he's America's CEO of Capital Markets over at Jones Lang LaSalle, joining us right here in studio.
I'm driving in my car, Turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It drives me crazy.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, just about 18 minutes left in today's trading session. We've got, as you heard from Charlie, a little bit lower across the board on the equity side of things. The concern is we've seen rates certainly move up. We've seen 2 days of some weak Treasury auctions, so not as much interest there, and that has certainly been weighing on things. 2-year note again, 497, 10-year note with a yield of 461. This as we get ready for a very important inflation print at the end of the week, the one that the Fed really focuses on. So we're looking forward to getting that a little bit later on. Having said that, let's see what's next.
Alex McGrath is Chief Investment Officer over at NorthEnd Private Wealth. Alex joining us from Greenville, South Carolina. Alex, good to have you with us this afternoon. How are you?
I'm doing great. How about you guys?
We're doing pretty well. Hey, I want to know what you're hearing from clients right now. You work in private wealth management. What are you hearing from clients? What are the questions that they're having right now, apart from, why didn't you get me NVIDIA 5 years ago?
That's certainly one of the more popular ones, as well as the YOLO one-day expiration call options. The others are typically centered around what do you think the Fed's going to do? What do you think inflation's going to look like coming up? Kind of what's going on with the underlying economy are definitely the top three things I hear.
So what is going on with the underlying economy?
So right now we find ourselves in an interesting situation where, at least based on the last GDP report, growth appears to be moderating a little bit, as well as, inflation continues to remain sticky here. So, you don't want to throw the stagflation term around, but it's kind of starting to wander into that area. So that's something that has been discussed.
That's interesting because we heard from Jay Powell, he sees no stag and he sees no inflation.
Mm-hmm.
Well, that's his opinion, I suppose.
Okay.
But
interesting.
We'll see what the next GDP report looks like. I think that'll give us a better idea.
Okay, given that that's the environment that you're seeing right now, how are you positioning clients to be prepared for that?
Certainly, at this point, the underlying macro data doesn't look, horrifically bad. We had the big GDP miss, but it's not like it came in negative. It was just much lower than expectations, while inflation has, continued to be higher than what we probably would expect it to be at this point, which is where I don't throw that term around lightly, but that's just you're kind of inching towards that environment. But as far as like the underlying macro data is concerned, jobs numbers continue to look good. We are still growing, albeit not as quickly. So, we don't see a ton of red flags sitting out there. Certainly, the last Treasury auctions, as you mentioned, the last couple of days haven't gone swimmingly well. And I think that's kind of been a headwind to the equity markets and the yield markets here for the last 2 days. But, as far as the underlying economy is concerned, we don't see a ton of red flags at this moment. So we're not pulling risk off the table or adding super defensive positions at this point.
I am curious, when investors have new money to put to work, are they more concerned, Alex, about just kind of preserving it, not so worried about gains? Or are they looking for outperformance?
I truly believe that completely depends on the individual investor themselves. We have not heard across the board people wanting to be super cautious at this point.
They're not. Okay, so not at all.
No.
All right, so where are the areas that they're looking or that you guys are channeling them into? Is it in the public markets? Is it increasingly in the private markets? What is it?
Certainly mostly into the public markets. We have a couple of private market investments, but that's not something we use typically across the board. But for 99% of our clients, it's all going into the public markets. We're still adding to growth positions at this point, perhaps not as strongly as we have been in the past, but that's still something we find, believe it or not, value in at this point. And from an equity concentration, some of our favorite sectors, one of our sectors we've added here recently has been utilities, a bit more of a defensive position, but certainly something on the back end that if these rate cuts do come to pass, that's a great spot to be sitting in. And so those are a couple of the places we're continuing to add to tech, and a few other sectors such as that. But, we're still very bullish on the equity markets in general right now.
That's really interesting, though, because utilities you would think of maybe as potentially a safer play a little bit. So you're kind of playing around.
You're absolutely right, and it typically would be. That is a particular sector that is interest rate sensitive.
Yeah.
So certainly in 23.
Yeah.
Not the greatest place to be sitting.
Right.
But, whether we get, the 6 cuts we thought we were going to get to start the year, or we get 2 on the back end, rates, they have signaled that rates are going to be moving down. And whether that happens in September, December, or March of next year, we do know that's going to happen. And that will help boost valuations in that sector.
Hey, Alex, talk to us a little bit about NorthEnd Private Wealth and sort of like the typical portfolio that you manage, the profile of your clients, and about the company a little bit.
Yeah, so NorthEnd Private Wealth is run by myself and 4 of my partners. I started at Raymond James. I was there for 12 years. All of my partners came from Merrill Lynch. Our typical client, we're not super heavy on the institutional side. It's, just normal people like you and me that come in for financial planning for us to manage their portfolios for them. So NorthEnd Private Wealth started in April of 2021. So we just passed our 3-year anniversary.
Very cool. Congrats. I know that you have a golden retriever named Huckleberry too.
I do.
I think is
a
fun fact. Everybody loves dogs, especially Goldens.
Absolutely a fun fact. Yes, he keeps he bears the brunt of my 5- and 6-year-old playing with him for sure.
Oh, I bet. And I'm curious who wants to take the nap first or gets tired out first. Hey, just before we go, give us an idea of assets under management. What kind of new money has been coming in?
So our AUM at this point is just shy of $1 billion. Unfortunately, we've had an excellent start to the gathering year. I think I looked at it last month, but I believe we are sitting somewhere in the neighborhood of plus 25 million at this point.
Yeah, so money continues to come in. Where don't you want to put investors right now?
Ooh, good question.
Thank you.
The long-term bonds.
Long-term bonds.
Yeah,
long-term meaning what?
Long-term.
Beyond 10?
I'm sorry.
Yeah.
Obviously, be much more specific there. Yeah, I would take anything over a 5-year duration. That is not something we have an appetite for at this point. And truthfully, across the board, almost everybody we talked to, almost everybody we listened to was like, hey, you've got to start adding duration here at some point. But going back to the beginning of the year, looking at all that macro data, looking at the jobs market, looking at what GDP was doing, those points were not making the case for rate cuts to be screaming down the pipe. And what's been an interesting question to look at across the board is, in the floating rate and short duration space, you're getting north of 5.5–6% on that without really taking any of the rate volatility. And that's just been, for us in managing the portfolios, we have chosen to stay there until we get a clear sign that CPI is going to move back towards the Fed's target and the rate cuts are coming.
All right. Great to get some time with you. Alex McGrath, he is Chief Investment Officer at NorthEnd Private Wealth, joining us from Greenville, South Carolina.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.